risk taking capacity or our risk exposure or our assets, which we are going to take into our book of accounts. The possibility of his coming non-servicing of debt may be 50%. So the impact will be, we assess traffic signal without on seeing this red signal, you are moving forward, you will end up into some dangerous situation. Prudential norms, limit, prudential limit, risk and tolerance level, RAROC. In the last session, we have been discussing about the probability and impact. The probability means the uncertainty which may come or may not, which may occur or which may not. That is the possibility of facing something. The uncertainty which we have to face in risk management, that is probability which may come. And what is it impact? How that probability will impact our transaction or our whatever the area of what you call your transactions or your actions, whatever it is, how it will impact our action. So that is the probability and impact, how it is related with the probability. What is the probability and how does it will affect our risk management portfolio? Then what will be the impact on our exposure with regard to the risk taking capacity? So that is the probability and impact score. Probability is nothing but it is the possibility of facing something unfortunate. That is the uncertainty. That is the probability. So why do we assess this probability? To assess what is the score, risk percentage. So we are concerned about the risk which we are going to take. How this probability will affect our risk-taking capacity. That is what we have to discuss more. So probability and its impact. So risk and basic risk management, this is coming under this unit 1. Probability and impact, we have to assign some score. Then only we can quantify. So there should be some tools to assess the probability and impact score. And using that two scores, we have to find out, arrive at the what is the percentage of the score. What is the percentage of the score means we have to assess how much it will impact our risk taking capacity or our risk exposure or our assets, which we are going to take into our book of accounts. How it will affect that probability. So there should be some score has to be assigned. So that assignment of score, we have to assign, suppose you are assigning a score between 1 and 2 for probability. And what is the impact if something we are going to face? So how it will impact our portfolio? So suppose one example is default. If the customer commits a default, so default is a probability, it's a possibility. So possibility, we have to assign a score between 1 and 2 based on the historical background, his payment records, all those things we have to assess, his financials we need to see, his transactions, his passbook, whatever the business nature of accounts, everything we take into consideration. Then we assign a score depending upon his past historical, what you call the way of doing his business and the history and all those things we will take into account. Then we will assign a score of 1 to 10. If the probability is high risk, this person has already committed so many defaults and all, to be on the safer side, we assign a score of 10. Okay, that is the possibility of his committing default into the account. So that is the score. Then comes to impact. What will be the impact? If impact will be his non-payment of his non-servicing of interest or non-servicing of principal into the book. So then comes so many risk components into our books. So we have to assign a score for that also. Probability and impact. If you multiply this probability score with the impact score, you will get the percentage of risk. Suppose 10 is the probability, maximum high risk category, we assign a score of 10. So we find that this is a high risk, the impact will be also more. 10 into 10, 100. High risk category. So if the probability is 10, again the possibility of his coming non-servicing of debt may be 50%. So the impact will be, we assess that the impact will be 5. So 10 into 5, the score will be 50, a medium risk. Like that, we have to find out the score, the risk score. For finding out the risk score, the basic tool which we use is probability and impact score. That is what it is described here. You see, probability scale and impact scale. We assign a score, probability score and impact score. So probability, there is a score we use. So probability scale, then the impact scale. You multiply probability scale with the impact scale, you will get the risk score. So P into I. Probability into impact will give you the risk score. Risk score is nothing but the possibility of default, the probability of default, or the risk percentage. Nothing but. In a sense, it is the risk percentage. If the probability scale is 0, this person is very good. He doesn't have a historical background of non-payment or non-commitment of default. So it will be 0. Then the impact score, we find that if the probability is 0, the impact is also 0. So the risk score is 0. So there is no problem in taking an exposure for this person. If the probability is 1 into 1, impact 1 into 1, so the probability score, the risk score will be 1. This is the low risk category. Okay. Then comes 1, 2, 3, 4, 5, 6, 7, 8, like that it goes. If it goes 6 is the probability score into impact score. If it is 6, 6 into 6, 36. So this is a medium risk. Like that, we can find out the risk score, risk percentage, risk score. Risk score. Risk score is equal to probability into impact. So in a question or case study or numerical, whatever it is, if you are given the probability and impact score of investment A, B, C, D, E, like that, you have to find out. The question will be like this. The business A has a probability score of this much. The business B has this, the business C, D, E, like that. Then the impact score also they will give. And you will find out, you will be asked to find out the which investment you will be preferring to. Which investment you will go for, or which proposal, which business you will recommend the higher authority to take an exposure or accept the proposal or reject the proposal, whatever it is. So according to the risk score, you have to arrive at. So find out the risk score, probability and impact. If higher the risk, there is a chance of non-taking of that exposure into our books. That's it, simple. So probability and impact, probability into impact will give you the risk score. Okay, we will proceed further. So through probability and impact, we can assess risk score, as can be seen from the table below. So just we'll see. Risk score formula is probability into impact. Suppose 8 into 8 is 64. 0 probability means 0 risk. That is what it is written here. 0 probability is 0 risk. Here it is 0 risk. That is the 0 probability. 0 risk. Here it is 8 into 8. So probability is 8 and its impact is 8. The risk score will be 64. It is, of course, not a medium risk. It is moving towards the high risk category. High risk category means you have to address more and more mitigating measures. So mitigations technique should be more, and you have to be very vigilant to take an exposure of such category into your books. That is what the implication or meaning of this probability and impact score. Simple. It is very simple. The questions mostly will be in the direct category. There won't be any much confusion or complication in this topic. Okay. So the score will be nothing but it is the probability and impact score. If in the question or case study you are given the probability and impact score, and if you are asked to find out the risk score, directly you multiply P into I, you will get the risk score. According to the risk score, you can take a decision. That is it will help you to take a decision. That in decision taking process, it will help you a lot. Risk score further explained is example. Facing a ferocious, this is another practical example, just is in your Macmillan book also, it is something, some examples like this, so many examples are also there. Facing a ferocious dog in an open veranda in a stranger house. So that is also one of the situations. See, you can relate all these banking transactions to the day-to-day life also. In the first sessions, we have been discussing about that you are walking through the rain, you are open, you are without an umbrella, it's a risk. You are facing a what you call your traffic signal without on seeing this red signal, you are moving forward, you will end up into some dangerous situation. Like that, in the every day-to-day life situation, this banking, this practical, this risk management is there. So it is related to a strange situation like that. Like that, you see the facing ferocious dog in an open veranda in a stranger house. So there is a probability of this dog. You are entering into a house, the gate is open, you are seeing that a dog is there watching you, and there is a probability of these ferocious dogs coming towards you and it will bite. So there is a heavy chance of heavy high risk chance is there that it may come. So you assign the score, the probability of that dog coming towards you, and also if the dog comes to you, impact will be the same. It will attack you like anything. So the impact will be the same, high. Always the impact will be high if it is coming towards you. So what is the chance of that dog coming towards you? You see the situation, probability scale we have to assign. Then the impact score you have to assign in this. Then you multiply P into I, you will get the risk score. See situation on facing dog face to face. So face to face the dog is, you are facing that dog. That means the chance of that dog coming to you is high, 10. The impact will be, it will attack you, high. Then the score will be 100. So it's a high risk. Then you see the situation, if the dog is caged, that if the dog is caged, okay, something safer situation. So you have taken some, what you call, the owner of the house has taken some what you call the addressing measures, some management, risk management measures he has already taken. So the dog is caged. Caged means that ferocious dog, there is a 50-50 chance, okay, it may come, it may break the chain and come towards you, or it will be remain there safely. So there is a chance, but to be on the safer side, we assign a score of 6 here, probability. And if it breaks the chain and come towards you, definitely it will bite you. So the chance of that impact score will be 10. So the bite you means here, everywhere the dog, if the dog comes in front of you, definitely it will bite. Then to bite means there is a chance of impact will be higher. So we assign a high score of 10 here. So the chance of coming towards you using 6 into 10, 60 is the risk score. So it is also a risk category only. So risk score is 60 here. Then the dog is caged as well as guarded by a trainer. Okay, of course. So guarded by a trainer means, okay, it is a very safe situation. It may not come to you. But to be on the safer side, we again assign a score of 1 here. Lesser chance only, but still, let the possibility of coming towards you is, we assign a probability score of 1. Multiply this with thing. So if it is 1 also, if it comes towards you in front of you, definitely it will bite. The impact score will be higher. So it is 10 only, the impact score. You multiply 1 into 10, you will get a risk score of 10 here. So he is a low risk category. So this type of assignments you have to do in your exposure also. So this is the practical situation, day-to-day life situation. Like that, in the banking scenario also, you can have such situations. You have to be very careful when you assign a risk score of this one. To be on the safer side, on seeing the situation, on assessing the financial or seeing the past history, you have to assign that score of probability, then the impact score, multiply these two things together, you will get the risk score. So this is how the risk is calculated. This we can compare with the risk in giving a loan. This is therefore the impact or probability of risk. This is the probability of risk. Probability of risk. Nothing but the risk score. In business or in credit, it is probability. In credit, what you will say? Probability of default. Of course, PD we have already discussed, the probability of default. Don't confuse it with the probability of default, which we calculated for the purpose of calculation of expected loss. You remember the last session, actually we have studied one formula. Expected loss is equal to probability of default into exposure at default, EAD, into loss given default, LGD. This is the formula. Just for the sake of by hearting the formula, I have been telling you have to by heart this formula, which will be helpful in the coming sessions. So here we use this probability of default. Here it is this probability is the risk score. Is the risk score to find out the risk score. So credit, of course, it is the risk score is related to the default score. Here in this probability of default, for the purpose of calculation of expected loss, is the default percentage. So that is also, there is another way of finding out the default percentage, this PD, that also you just note down. PD to find out another way. If you are given impact and post probability scores, you have to use this risk score percentage calculation. Sometimes you will be given number of bad debts, or NBA account, bad debts. And also you will give number of standard assets. Then probability of default will be number of bad debts divided by number of standard assets. Use this formula at that point of time. When it comes in the numerical session, we will discuss more. Okay. So probability of default, normally the bank calculates the probability of default by dividing number of bad debts with the number of standard assets. You will get, you have 10 accounts bad debts, out of which you have 100 accounts are standard. Out of that number of standard assets, 10 became bad. So what is the percentage? 10% is the PD, like that. But to assess the risk score, if you are given the probability at impact score, use this formula, P and I. Risk score is equal to probability and impact. So depending upon the case study which you are getting for calculation of a probability of default or risk score, you have to use these tools, either this P and I or this number of bad debts and number of standard assets, like that. So depending upon the data which you are given to solve in your examination. Okay. So this is how the risk is calculated, P and I, using the P and I. So probability of default or probability risk score is calculated by using the probability and impact. Another terminology we need to familiarize with is risk appetite, of course. This is one of the questions which may come for your MCQs. Risk appetite. Risk appetite is nothing but, in the scenario you take risk appetite, how much risk you can take. The risk appetite, for the best example is housing loan. They say that this is the maximum amount of ceiling or overdraft amount for this particular unit, this particular manufacturing unit. The maximum is this much amount is. That is the risk appetite. Beyond that you cannot take. That's a risky situation. So that is the risk appetite. What is the best example? The breakfast consumption of food, example, 4 idli plus 1 seed. This is basically our appetite. We can take that much only. That is what is in the banking scenario also. For that particular unit or for that manufacturing unit, suppose the plastic industry, plastic manufacturing unit, we are fixing a limit of this much only. For that particular segment, you cannot go beyond that. That is the risk appetite every bank has to take. So that is the risk appetite, the maximum exposure which a bank can take on a particular sector or segment or product or whatever it is. That is risk appetite. Then comes what? Risk tolerance. So risk tolerance, risk appetite and risk tolerance. Risk tolerance is nothing but, see, you have taken an exposure of 100 lakhs. Okay, your bank says that, okay, you give the overdraft limit to that particular kind of industry, 100 lakhs is the maximum. That is the risk appetite. Then the bank says, sometimes, some emergency situation, they will need something more than that of it. 100 lakhs is their sanction limit. Sometimes, depending upon that industry, nature of industry, they may need of something more. So if 100 lakhs they have already drawn, immediately they have to meet some immediate payment requirement of another 10 lakhs or something like that. So their bank says, okay, you can allow a over and above a certain amount, you can allow. Beyond that, you cannot. There also a ceiling is there. But beyond that risk, over and above the risk appetite, you can give something more than that, some 10% or 20%, whatever it is. One best example is temporary overdraft, isn't it? Temporary overdraft which we give to the customers. The overdraft, if 100 lakhs is the limit, sometimes we allow 20% above the limit, up to 20 lakhs also, we can allow for 10 days or 21 days or whatever it is for 1 month maximum. Temporary overdrafts we allow. So that is risk tolerance. Beyond that, you are not supposed to go any a single percentage. That is risk tolerance. Example, the marriage function, lot of item gifts, compulsion comes, can go something extra. So they very politely, they very lovingly, the people are coming, you eat something more like that, they will compel you. Okay, you can take something more than that. Beyond the appetite, a tolerance level we can use. Like that in the banking scenario also. That is what risk tolerance. So this is what is applied in branch scenario. Like the food which we are consuming, so like that, the bank also consuming some exposure. So you can relate that thing with the banking scenario. For example, your junior level officer or MM2 officer or senior level officer can sanction level. They have a sanction level, isn't it? That sanction level, the bank fixed the sanction level for JAIIB. If I am in middle management or I am in senior management, I will be given a passing power, a sanctioning power of 50 lakhs is my sanctioning power. Okay, that is the risk appetite. The banks give you the, so this particular officer can sanction 50 lakhs only. That is the risk appetite. So he will allow a certain percentage of 20% of, so this senior officer is empowered to sanction another 20% as loan. That is the overdraft, temporary overdraft. That is the risk tolerance. That is what is described here. So this is what is applied in branch scenario. For example, JM1 scale 2, 3, 4, etc. Sanction level is at 10 lakhs, 20 lakhs, 30, 40, etc. This is appetite. Bank also allows the sanctioning authorities an additional 20% of sanction limit. That is the risk tolerance. So additional 20%. That is the maybe a 10%, 20%. This is for the purpose of understanding only. 20% of sanction limit as temporary excess or ad hoc limits. We say ad hoc limits also. So ad hoc limits is nothing but the part of risk tolerance, not the risk appetite. So which is the tolerance level? Anything if they sanction above this tolerance level is a risk. So the bank say that up to this level you can go. Beyond that, if you go, it will be a risk. There comes the accountability part. Sometimes, aggressive manager may sanction over and depending upon the pressure. Okay, on seeing the pressure put by the customer, we may allow over and above the limit. If the accounts goes bad, of course, it is a high risk. So there comes the accountability part and also. So one has to be very careful with regard to management of risk, with regard to this tolerance and risk appetite. Risk appetite and tolerance level, these two terms you have to remember. Okay. Management of risk is a major concern for top management. Of course, we know. If it requires a separate setup for our framework. See, this is important. This comes the next topic, hierarchy. Organizational setup. What is the organizational setup or the framework of risk management? What are all the departments? Who are all assigned with what kind of duties and responsibilities with regard to risk management? It is called the hierarchy of risk management. It requires a separate setup or framework to issue loan policy, setting up of prudential norms, prudential limit, risk and tolerance level, RAROC, risk adjusted return on capital hurdle rate. We use the hurdle rate, benchmark. We use, if they say that 10% is the benchmark, the benchmark RAROC should be 10% means it should not go below. Even after adjusting the risk component in your net profit, you have to come out with a minimum risk adjusted return of 10%. That is the RAROC hurdle level. This also fixed by the framework. What are all the framework? Who are all involved? Let us see one by one. So RAROC management, requirement of special skills, etc. These are all the duties and responsibilities of the risk management framework. Risk management framework. So this framework, who are all there? Who are all the responsible persons? What is the hierarchy chart we need to see? Okay. Now, risk management framework is an organization as well, in an organization is a well articulated process covering the following areas. Which areas they have to cover? Organization for risk management, that is the hierarchy. Organization for risk management. So, organization for risk management involves from the top management to the operational level, front desk operational level, there should be an organizational setup like that. So, somebody should be in the top, then comes the another supporting group, then comes the various other groups like that. They have to function like that. Then comes like that. So, this type of organizational setup should be there. Here comes the frontline officers who supports all those things. So, from here one has to report here, from here one has to report here, from here to report like that. So, this is the organizational setup, a framework which every bank has to form and implement. So, that is the hierarchy. Then comes what we discussed is a part of organizational framework. In addition to this, there comes the process of risk management, which we have already discussed like that. Risk identification, risk measurement, risk pricing, risk monitoring and control, then finally the risk mitigation. So, all these processes, all this management involves the part of this framework, risk management framework. So, hierarchy or organization for risk management. Here also you can expect something for your examination MCQs. Hierarchy. What is the top management, the appellate authority to take a decision? Who evolves policy? Who is responsible for putting up policies and procedures? Who will implement? Who will guideline? Who will guide? So, like that, so many things, responsibilities are involved. Who are all the persons, departments involved? Let us see one by one. So, hierarchy or organization for risk management. Usually, risk management organization consists of first the board of directors. This is most important. So, first the appellate authority who takes care of the policies and procedures, the systems and procedures comes from this board of directors. Okay. Then comes, so the authority, the higher authority, the first and primary higher authority is board of directors. Then it's followed by the risk management committee of the board. So, 2, the risk management committee of the board. 3, the committee of senior level executives, also called subgroups. This is the senior level executives. So, the first one is board of directors, then the risk management committee of the board, then comes the senior level executive subgroups. Subgroups consists of, you see, subgroups consists of asset liability committees, various committees, ALCO, asset liability committee, credit risk management committee, CRMC, organizational risk management committee, ORMC, like that. So many committees are involved under these third subgroups, that is the senior level executives. The first one is BOD, board of directors. The second one is risk management committee of the board. Then comes the senior level subgroups, various committees. Okay, asset liability, credit risk management committee, operational risk. In addition to 1, 2 and 3 above, there is another department called the risk management support group. So, this support group will give you the data. They collect the data from here and there on the market and all these corporates everywhere. They go outside, they collect data, and this data will be given to the committees. The committee will report to the board, risk management committees, the senior level risk management committee. Then they report to the board of directors. So, that is the functionality of or the hierarchy of risk management framework. So, ALCO, asset liability committee, what are all the functions? CRMC, what are all the functions? The basic functions of ALCO, asset liabilities committees, we have already discussed. It will tally, it will compare the assets and liabilities with regard to volume as well as the maturity pattern. And you will see whether there is any gap between the two. If there is a gap, they have to address that. So that is what ALCO does. Oversees the liquidity risk of the bank. Monitors and tries to protect or improve the NIM, net interest margin. That is the NIM, net interest margin. Then net interest income, NII, what is NII and all, recommends BPLR or base rate or MCLR, RLLR of the bank. Then mid-office group, monitoring of treasury operations, etc. are done by ALCO. So, ALCO functionality oversees, mainly it oversees the liquidity. Liquidity means asset liability mismatch they monitor, and also the profitability, net interest margin and net interest income. Net interest income means interest income minus interest expenses. Net interest margin means net interest income divided by earning assets. That is the formula which we will discuss in the coming session in detail. So, that is the function of ALCO. Then CRMC will take care of the credit risk management committee, all those risks involved in the credit portfolio, ensuring robustness of the credit risk, manage entire credit folio, credit rating process, models working out, etc. Then working out yearly probability of default for individual ratings as well as average probability of default. Mainly the default probability they assess. Conducting portfolio analysis for retail loan assets or clear any new credit products or processes put up by the business. That is what this credit risk management committee does. Then comes what the other management committees, operational risk management committee is there. What they do? Functions is monitoring operational risk, analysis of frauds and suggesting mitigating measures for a non-recurrence, etc. Operational risk management systems and failure when it fails. So, this committee will come into action and they will take care of the addressing those issues. Risk management support group functions, analysis, monitors and reports the risk profiles to the committee of senior level executives. Going from the ground layer, it reports to the higher authorities. That higher authority is the next level and finally to the higher level. That is the function of this risk management framework.